We have exactly 12 days. On February 27th, the COMEX faces its biggest test in a decade, and for the first time in history, the registered inventory has collapsed below the critical 100 million ounce safety line. If you think this is just another hype cycle, look at this chart, because what happens in the next 2 weeks could trigger the $100 squeeze we've been waiting for, or a massive trap for the bulls. OG Jhone AG here. Now, if you're actually learning something here, if you're verifying the data and it's sharpening your view, comment OG Jhone AG below. And if you're tuning in right now, buckle up, because we're diving deep into what's shaping up to be one of the most explosive silver stories of the year. We're talking about potential supply squeezes, inventory meltdowns, global deficits that could make your head spin, and the mechanics of a full-blown silver squeeze that could send prices skyrocketing. I've pulled together all the latest data, corrected some outdated figures from recent buzz, and crunched the numbers to give you the real, unfiltered analysis. No fluff, just facts backed by deep dives into COMEX, SHFE, and global trends. If you're new here, this is COMEX Insight. Hit that subscribe button now so you don't miss out on these game-changing updates. Let's get into it. First off, let's unpack the wild scenario that's got everyone buzzing. What happens if a ton of traders demand physical silver delivery on February 27th, the last trading day for the March 2026 COMEX contract? Folks, this isn't just hype, it's a powder keg waiting to ignite. As of right now, February 15th, COMEX registered silver, the stuff actually available for immediate delivery, sits at a shockingly low 98 million ounces, down from higher levels just weeks ago. That's right, below the 100 million ounce threshold, a psychological barrier that's got traders sweating. Total inventories, including eligible silver, are hovering around 380 to 394 million ounces, but remember, eligible isn't automatically deliverable, it needs owner approval to convert. With global demand from solar panels, electric vehicles, and industrial tech exploding, a surge in physical stands could trigger a massive supply crunch. Analysts are whispering about prices spiking to $100 or more if this plays out, especially with supply deficits projected at over 200 million ounces in some forecasts. But hold on, I'll correct that in a bit with the latest from the Silver Institute. On the flip side, history shows that over 90% of contracts typically cash settle, so if most traders opt for that, the impact could be minimal. Prices might even stabilize or dip as the physical pressure eases off. But here's where it gets juicy. The dollar's been weakening, with the USD index at around 102 amid Fed signals, and if it drops below 100 next week, like with weak non-farm payroll revisions or dovish ECB moves, algos could jump into short silver hard. We're talking potential drops of less than 5% that get bought up aggressively by retail and hedge funds, just like we've seen lately. Your crash cascade idea, 35% plunge, then 25%, then 10%, reminds me of the 2021 meme stock squeezes, but on steroids for silver. And with China buzzing about restocking even before full reopen post-Lunar New Year, Asian demand could kick in early and light the fuse. Spot silver right now? About $78 per ounce as of this morning, up slightly but still in backwardation, where near-term futures trade at a premium, signaling scarcity. To ground this, open interest on COMEX silver is up about 15% month over month, with the March contract alone at around 58, 770 contracts, that's roughly 294 million ounces of exposure, against just 98 million registered. Shocking, right? If we see short covering, we could hit $90 before any real squeeze. But this is speculative. Markets shift fast, and narratives like this drive the action. SLV ETF flows? They've been net positive, a leading indicator of building bullish sentiment. Now, let's zoom in on COMEX inventory trends, because this is where the rubber meets the road. COMEX silver stocks have been on a roller coaster, showing massive volatility and a downward spiral from late 2025 into early 2026. Driven by surging physical demand, industrial gobbling, and speculative bets, we've seen stocks migrate due to 2025 U.S. tariff fears, then accelerate in drawdowns amid record deficits and delivery pressures. Key breakdown. Registered inventory, the immediate delivery stuff, is the stress point. It's been plummeting, signaling squeeze risks when it tanks relative to open interest. Eligible is quality approved but not yet committed, and total is the sum. The trend screams structural deficit. The Silver Institute pegged a 230 million ounce shortfall in 2025, narrowing a bit in 2026 due to high prices forcing some demand rationing in solar and electronics. But early 2026, no relief, multi-year lows with high deliveries. In 2025, stocks built up early as hundreds of millions of ounces moved from London to New York over tariff panic, peaking around September at 532 million total. Then October kicked off the depletion. 167 million registered, 329 eligible, 496 total. Fast forward to early January 2026, sharp 33.45 million ounce weekly withdrawal. 26% of registered at the time, down to 123 registered, 291 eligible, 414 total. JP Morgan was dominating those deliveries, folks. January 7th, post-withdrawal registered at 120 million. Late January, 102, 103 registered, 291 eligible, 394, 415 total, lowest since March 2025. February 9th, 102.55 registered, 291.96 eligible, 394.51 total, with a 0.88% weekly drop and coverage ratio at 55.1%, screaming high squeeze risk. Then February 11th, registered dipped to 98.14, 101.3 million. Eligible approximately 287, total tilde 389, 394, after a 3.26, 4.19 million ounce single day registered drop and 4.7 million net withdrawn. Mid-February estimate as of today, registered under 98 million, eligible approximately 285, total under 390, with February deliveries already at 23 million month dash-to-dash-date. Demand pressures? Industrial solar, EVs, electronics are outpacing mine supply. Annualized physical settlements in early 2026 hit 80% of global mine production, which is 850-900 million ounces yearly. Coverage ratios down to 24 to 55%, heightening default fears. Prices peaked at $121 per ounce late January, corrected to $77.82 mid-February on CME margin hikes and risk-off vibes. Low stocks make every move amplified. Goldman Sachs analysts note this sensitivity. Downward momentum registered down 40% from October highs of 167 million to under 100 million, total down 20 to 25% from September peaks. February seeing 4 to 5% weekly drops way beyond seasonal norms. Risk indicators, ratios below 60% historically precede squeezes, and if deliveries hit 25 to 30% of open interest, March could need 32-38 million ounces, exhausting 30 to 40% of remaining registered. Globally, SHFE down 75% year-over-year to approximately 350 tons, LBMA declining, Western pricing power shifting to Asian physical markets. Bank of America eyes $309 long-term, amid tight supply. Without big inflows from mines or recycling, dips continue, supporting highs despite volatility. Watch CME margins. They triggered a 12% drop early February. If trends hold, COMEX faces delivery hell by late February, lining up with that February 27th squeeze speculation. Shifting gears to the global silver supply deficits. This is the backbone of why silver's on fire. The market's been in a persistent structural deficit for years, demand crushing supply from mines, recycling, everything. This draws down above-ground stocks, propping prices long-term, even with short-term wild swings from margins or macros. Historical 2021 to 2024 saw consecutive deficits, peaking over 200 million ounces. Some years, like 149 million in 2024 per the 2025 World Silver Survey, 2025 narrowed to 117 million ounces, fifth straight year fueled by record industrial demand in solar, EVs, electronics, outstripping modest mine growth. Cumulative, over 5 years through 2025, deficits total 800 plus million ounces, nearly a full year's global mine production of 850-900 million. For 2026, Silver Institute's February prelim outlook says sixth consecutive deficit at 67 million ounces, a reduced but still massive shortfall. Total supply up 1.5% to decade high, 1.05 billion ounces from mine and recycling gains. Demand steady overall, with retail/physical investment jumping 20% to 227 million ounces, highest in 3 years, offsetting drops elsewhere. Industrial fabrication down 2% to 4-year low 650 million ounces on price-induced thrifting in solar. Jewelry and silverware lower too. Deficit still relies on inventory draws, keeping markets tight. Drivers, supply constraints 70 to 80%. Silver is a byproduct of copper, lead, zinc, so slow response to prices. Limited new mines, flat output. Demand, industrial dominates 50 to 60%. Green energy like solar sucking 100 plus million yearly. Investment booms in uncertainty. Inflation, weak dollar. Inventory erosion, COMEX registered below 100 million with drains. SHFE plummeted to 350-423 tons, 75 to 90% from peaks. LBMA down to 27,000 plus tons. These lows amp squeeze risks on delivery spikes. Implications. Even 67 million deficit in 2026 is bullish. Market can't balance without eating stocks or killing demand. JP Morgan, Bank of America see elevated prices. Long-term targets way above $78 spot today. High prices prompt thrifting, shrinking the gap. Ties to COMEX. Low registered heightens March risks if OI stays high and stands rise. Structural setup favors squeezes if institutional demand holds. This is preliminary, full 2026 survey in April. But folks, 800 plus million cumulative deficit, that's a shocking hole, equivalent to wiping out a year's mine output. Concern? Markets could fracture if deficits persist, with physical decoupling from paper. Now, that's HFE, silver inventory trends. China's exchange is in even deeper trouble. accelerating declines to near 10-year lows early 2026. Intense physical demand from industrial solar, electronics, EVs, plus investment outpaces supply amid global deficits. SHFE stocks are deliverable in Chinese warehouses, key for domestic availability. Lows triggered regs like stricter hedging and margins to curb spec and defaults. Depletion, fallen 85 to 90% from 2021, peak of 3,091 tons, lows since 2015 from outflows to surging demand, exports to LBMA in 2025, unreplaced consumption, early February 2026, tightened rules, zero hedging for non-approved in near months from late Feb, backwardation heavy, premium signal shortages. Data, January 12, 2021, 3,091 tons peak, end 2024, early 2025, 4070 tons, early January 2026, higher pre-draw, February 6th, 349.9 tons, February 8th, 9, 318.5-318.5, 46, sharp 31-ton drop, 88 to 89% below peak, February 10th, 323.368 rebound, February 11th, 342.102 uptick, still 89% down, prompted rules, February 12th, 349.633, February 13th, 353.559, mid-Feb est, 350 tons, no big inflows, .YOY, 75 to 90% down, 2025 to 2026 accelerated 40% plus in periods. Combined SHFE plus SGE, approximately 26 million ounces equivalent critically low. Historical median since 2012, 1,116 tons, current 70 to 80% below. Implications. Squeeze risk high with 350-400 tons, approximately 11-14 million ounces. Spikes and stands could strain like COMEX. Naked shorts exceed stocks. Default fears. Persistent lows bullish. Backwardation shows scarcity. Global linkage. Tightness pulls metal. Exacerbates drains. Outlook. No ramps in mine, flash recycling, or demand kill. Stays suppressed. Watch margins at 21 to 22%. Post-New Year restock. Supports pre-reopen squeezes. Volatility cascades. This parallels COMEX, amplifying global narratives for late Feb-March. Comparing SHFE to COMEX, both hubs for silver futures, but dynamics differ. SHFE tied to China's 40 to 50% global consumption. Physical heavy. COMEX Western benchmark. Speculative. 2026. Both extreme tight, inventories low, amid 67 million deficit, demand surges, drawdowns. Parallel risks, interventions, premiums. Primary role SHFE domestic hedging / physical for Asia industrial. COMEX global pricing / spec inventory units SHFE tons 1 tilde 32 150 ounces. COMEX million Oz. Latest mid-Feb SHFE 342 353 tons 11-11.3 million ounces. COMEX registered 98 102 million. Total 385 394 million. Decline percent. SHFE 88 to 90% from 2021. COMEX registered 40 to 50% from late 2025. Total 20 to 27%. Trends. SHFE sharp drops / fluctuations. 10-year lows. COMEX accelerated drains. Below 100 million milestone. Coverage / squeeze. SHFE high risk. Zero delivery rules end Feb. COMEX 20 to 55% coverage. Fears around Feb 27 March. Premiums. SHFE heavy backwardation, 5-15% plus over COMEX $110/Oz recent. COMEX baseline, less extreme. Regs 2026, SHFE margins 21 to 22%. Hedging limits, COMEX emergency hikes, 18% plus. Demand, SHFE Chinese industrial 70% imported. Retail surges. COMEX global investment industrial western drains to Asia. OI/exposure. SHFE high less transparent, naked shorts. COMEX 150,000 plus contracts recent, March high versus 98 million registered. Insights, historic erosion from same deficit. SHFE depletion, more acute percent, stricter rules, COMEX registered drop signals vulnerability pre-key dates. East-west divide, SHFE premiums show China hunger, two-tier market. Metal flows east exacerbate squeeze potential, applies both if stands rise, force covering / interventions. SHFE cap spec delivery, COMEX conversion / cash. Outlook, bullish fundamentals, volatility from margin / dollar. Shanghai premium could widen on restock. Shifting power to physical / Asia. Intertwined drains could fuel March fireworks. Finally, silver squeeze mechanics. When physical supply chokes versus paper claims, shorts cover at rising prices. Feedback loop of buys, volatility, spikes. COMEX context, paper futures versus physical vaults. Dual market, leveraged paper over small physical, 2026 vol, registered 98 102 million, high OI, 67 million deficit, SHFE tight risks around late Feb-March. Step by step, build up big players short without metal. Each contract 5,000 ounces, OI hundreds millions versus low registered ratios 100.301 plus. Trigger demand surges, industrial/investment/Asian, stands for delivery, eligible conversions, vault drains, COMEX, Jan-Feb, sharp, SHFE 85 to 90% down, coverage 50-60%, shorts exposed, ignition, shorts buyback deliver, impossible metal, prices up, margin calls, liquidations, more buys, algos amplify 3 to 5% spikes, backwardation emerges, SHFE premiums, COMEX spreads, amps, gamma, options, hedge buys, lease rates 8%, geofractures, SHFE 5-15% plus pulls east, interventions, margin/rules, accelerate if longs firm. Extremes, force majeure like 2022 nickel, suspend/cash/halt, paper irrelevant, physical dollar, 150-300 plus short term, reprice to OTC/Shanghai, ETFs premium/break, miners soar. 2026, why? Registered 100 million crossed, March OI approximately 294 million, 25 to 40% registered, if stands rise. Why? SHFE 11 million equivalent, deficit 6th year, no quick fix, byproduct. Cash settle most, muted, but 20 to 30% stands amid weak dollar dip buys. Cascade to squeeze. Not spec, mechanical when paper physical. Parallels, 1980 hunts, 2021 retail, 2022 nickel, violent but intervened. Feb 27, flashpoint, stands, registrations, premiums, physical over paper, hard spikes. Who, that's the deep dive, big numbers like 800 million cumulative deficit, shocking drops like SHFE 90% gone, concerns over defaults, straining systems. Now let's do a quick reality check on all this squeeze talk, because folks, while the data is screaming potential fireworks, markets don't always follow the script. I've seen enough cycles to know that hype can build fast, but so can the rug pulls. First, the bull case is solid, with that projected 67 million ounce deficit for 2026 from the Silver Institute's prelims, and cumulative deficits north of 800 million over 6 years. We're essentially mining the vaults to keep up. Add in solar panel demand alone, expected to gobble up 140 million ounces this year, as global installations hit record highs amid net zero pushes, and you've got a recipe for sustained upward pressure. EVs are another beast, with Tesla, BYD, and the big autos ramping production. Silver's conductivity makes it irreplaceable in batteries and wiring, pulling another 50-60 million ounces annually. Mining output? Flat, at best. Peru's strikes, Mexico's water issues, and byproduct constraints from copper slowdowns mean supplies not bouncing back quick. Recycling's up 5 to 10% thanks to higher prices, but it's not enough to plug the gap. But here's the bearish flip. Reality check number 1. Central banks and regs love to play spoiler. Remember early February's 12% price drop? That was straight from CME hiking margins to 18%, forcing leveraged longs to liquidate. If we see a whiff of squeeze heat by February 27th, expect more of that. Maybe even emergency rules like SHFE's zero hedging clampdown. Probability. I'd peg a full-blown squeeze at 20 to 30% odds right now. Most contracts roll or settle cash, as history shows. Over the last decade, only about 5 to 10% of COMEX silver OI ends in delivery on average. If hedge funds smell blood and pile into shorts, we could see a quick 10 to 15% dip below $70, testing those dip buyers you mentioned. And don't forget macro headwinds. If the Fed pivots hawkish on hotter-than-expected inflation data next week, say CPI revisions showing 3.5% instead of 2.9%, the dollar could rebound to 105, pressuring all commodities. Gold's already feeling it, down 2% this week. Silver often amplifies that by 1.5x. Engaging market research time. Let's talk key players and their moves, because this isn't just numbers, it's a chess game. JP Morgan's still the 800-pound gorilla in COMEX vaults, holding about 40 to 50% of registered silver as of mid-February data. They've been net deliverers in January, shipping out millions of ounces, but whispers from trader forums suggest they're repositioning for a long play, maybe converting eligible to registered if prices tank short-term. On the hedge fund side, Citadel and BlackRock have ramped silver exposure via ETFs. SLV inflows hit $500 million last month alone, a 15% jump. But watch the miners. Pan American Silver and First Majestic are up 25% YTD on production beats, yet their forward guidance warns of cost inflation eating margins if silver stays under $80. Reality check 2. If we don't see fresh inflows from new projects like that big Australian mine delayed till 2027, supply could actually surprise to the upside by mid-year, easing deficits to 50 million ounces. I crunched some numbers from USGS reports. Global mine production might edge to 910 million ounces in 2026 if copper rebounds versus the 850-900 baseline. Now, for some global flavor, let's zoom out to India and Europe, where demand's adding fuel. India's silver imports surged 30% in January, post-festive season, hitting 1,200 tons as jewelry and investment bars fly off shelves amid rupee weakness. Europe's not slouching, with EU green mandates, industrial offtakes up 12%, but thrifting's real. Companies like Siemens are swapping silver for copper alloys in some electronics, potentially shaving 20-30 million ounces off demand. Engaging stat, per LBMA data, OTC trading volumes in silver are up 18% YY, signaling big money's rotating in as a hedge against AI-driven energy booms. But reality check 3. If Bitcoin or gold steal the spotlight, BTC's at $120K today, pulling speculative flows, we might see silver lag, trading sideways in the $70.85 range till Q2. One more juicy bit of research: historical squeeze thresholds. Back in 2011, when COMEX registered dipped to 30 million ounces against high OI, prices rocketed 50% in weeks before crashing. Today, with ratios at 3:1 OI to registered 294 million exposure versus 98 million available, we're not at panic levels yet, but cross below 2:1 and it's game on. My take: the squeezed threshold hits when deliveries exceed 20% of OI and backwardation widens to $2/OZ. We've seen flashes of that already. Alright, team, that's the full breakdown. Explosive potential meets real-world checks. If this squeeze ignites, it could redefine silver for years. If not, we're still in a bull supercycle with deficits calling the shots. What's your price target for March $100 moonshot or $70 dip? Drop it in the comments, like if this helped, and subscribe for daily updates. I'm OG Jhone AG. Stay sharp, trade smart, and see you next time. Peace out.